Hey, good evening, stock investors, stock traders, and welcome to my live stream. This live stream is going to cover stock investing, and I thought we could take our time as we look at either stocks or talk about a topic and kind of go through each step of evaluating a company to see if it's a good investment. Now, I look at stocks and I try to get to their fundamentals and try to calculate an intrinsic value for a stock. What are the future cash flows worth for that business? What are the future profits worth for that business? And that's what I'm going to do when we look at a stock. I could also take on topics around investing. It might be, hey, how do I evaluate the moat, the competitive advantage or barrier that a business might have? I could take on topics. I'll go where the call wants me to go. And if you've been to my live streams before, and you could put a stock in the chat if you're a member, I just go where members take me. If you're not a member, no big deal, $5 super chat, and your stock will be reviewed. Or you can bring up a topic. It's a little bit of a change that I wanted to make on the evening streams. You might want me to get into a topic and really go to town on a particular investing topic. Looks like we've got our first comment. Real Wild Goose, good to see you. Yeah, I appreciate the comment. Thank you. Looks like you're an Orioles fan, so you might be tuning in from Baltimore or that area. All right, so the market this week has been going up, and some stocks more than others. And I'll show you the heat map in a little bit, showing that some stocks are really flying up. But overall, the last 2 days for the S&P have been terrific. The NASDAQ, real positive. The Dow is up nicely. And when we look at the heat map, in today's trading, NVIDIA sold off. And at one point, NVIDIA was sold off by close to 7%. That was really hard to fathom. Like, why are they selling off so much? And this space of like the data center was sold off pretty harshly. AMD was sold off by a lot. So was Micron. But it bounced back to some extent. Broadcom is catching a nice bid. They are involved with our friends over at Google. And Google has really caught fire. Google stock has really been going up for months now. It's really appreciating stock. They've got a lot of things going for it. We had the release of Gemini 3 was really well received by the market, and that stock has really been rallying. Now, if you've been watching my streams for a while, maybe for the last couple of years, and you've been seeing my videos, you would attest that Google was the stock that I was really pointing to in May, June, saying out of the most valuable stocks, that's the one that I had the strongest conviction around. And I bought a lot of shares. And I'm really glad that stock's really rallied higher. It's really done much better than I imagined, and I'll take it. The other stocks that I'm pretty high on, Amazon, I'm pretty high on Amazon. I think they're being counted out or maybe not given credit for how good they are. And if you watch my videos, you'll see why. Other spaces have been catching a bid. We've got the healthcare space, and these guys have been green for about a couple of weeks, especially on days when tech's giving up some of their capital. It's getting over to the healthcare side. The healthcare space did receive some encouraging news coming out of Washington. You have the current president is, I believe, the whisper is that there is going to be a substitute or maybe some new version of a subsidy for the Affordable Care Act subsidies that went away. And that's so that people could afford their health care. That really helped Some health insurance payers like Oscar Health went up 22% yesterday. Today was up just a little bit. And it also helped the space in it as a whole. So the healthcare space has had a couple of good weeks. Good to see that. Energy went down today. Some staples caught a bid. Meta has had a couple really good days. Meta had been strongly sold off after their earnings, and now they're coming back. That's a good stock, in my opinion. Looks like Patrick is on. Good to see you, Patrick. I've never heard of Drone Shield. Yeah, and I can't speak for all U.S. investors, but I've never heard of it. Magical Self. Good evening. You want to take a C Limited, and I did buy NVIDIA today. I bought just a starter position of NVIDIA. I didn't want to make too much news out of it because it's a really small position. I own a lot more C Limited though, and I bought some C Limited today as well. So I'm going to give you my thoughts on C Limited, show you the discount that I'm seeing, and tell you what kind of position size I'm going with there. And C Limited, for those that are not familiar with C Limited, they're a company that is officially headquartered in Singapore. A lot of their business happens in Asia. And they're a communication services company providing different categories like gaming, video gaming. They do some e-commerce. They do websites. So they are quite successful, growing really well. And I'll show you more fundamentals when we can get into C Limited. And we'll do a full valuation. And I'll share with you what I like about C Limited. And I'll show you some of its peers and why I like that particular sector quite a bit. And I own Google, Meta, I own Reddit, I own C Limited, I own Amazon, and we'll get into that in a few minutes. Good to see you, Magical Self. Thanks for tuning in. All right, so we got one name on the board, one stock. We also had some stocks announce earnings. Once I get through that first name, I'm going to come back and we can take a look at Dell, and we can look at Autodesk, Workday, Zscaler, and Alibaba, if you'd like. Looks like Bo is back. Bo is a regular. I am doing great. Thanks, man. Very generous of you, because every time you show up with $2. That's going to add up, and I really appreciate it. Good to see you. Let me know what you'd like to talk about today. So we've got some stocks to take a look at that have some fresh earnings. A couple retailers down here, but I'm going to focus on probably the bigger companies up here. Alibaba, Analog Devices, Dell. We'll take a look at those after we're done with C Limited. All right, so let's get into looking at stocks. And in the evening streams, what I wanted to do is kind of slow things down. And I'm going to really, kind of go step by step and try to keep an eye on the chat in case you have any questions. Please ask, especially Magical Self. If you have some questions on C Limited, please put them in there and we will handle your questions. All right, so let's take a look at C Limited. All right, C Limited, through its subsidiaries, operates as a consumer internet company in the Southeast Asia, Latin America, the rest of Asia, and internationally. The company operates through e-commerce, digital financial services, digital entertainment segments. It offers Garena, a digital entertainment platform for users to access mobile and PC online games, as well as promotes esports operations. Okay, so to kind of get a visual on the kind of company we're going to deal with, I think we're dealing with a content company. communications company, and they've become a fairly large enterprise. When we look at their financials, if we look at the full year, and this is in US dollars, this is a $16.8 billion revenue company. So that's a pretty good size. I'm going to compare them probably. You can't compare them to Meta's because Meta's so darn big, but at 16.8 billion, they're a little bit bigger than Reddit and probably bigger than Pinterest. But I'll open up Reddit here and kind of have it as a company to compare against. Reddit had a terrific day today, by the way. 12%. I do own Reddit. Reddit's a $41 billion market cap company with $2 billion of revenue. C Limited, on the other hand, 80 billion, twice as big, but they have $21 billion of revenue. So it's quite a bit bigger, 10 times bigger from a revenue standpoint. The PE ratio on C Limited, 59 PE, 31 forward PE. So it is a little pricey. And when we look at their growth rate, especially on the quarterly, 38% is fantastic. That's excellent growth for a pretty good sized business. This is not a small business. Growing at 38% is really impressive. And you see that quarter after quarter, they've been growing really, really well. Now they've been doing this and the market's paid attention. It's gone up over the 1 year, year to date, it's up 28. And this is a stock that sold off after, like, a couple of years ago. Chinese stocks were just not as desirable as one would think. And they started to sell off a couple of years ago. But if you look at where this stock's been, you could have bought this stock at $36 a share and tripled your money, quadrupled your money, actually, because the stock's really risen from there. Because investors are seeing that growth. And in addition to that growth, they have, let's take a look at their margins, 42.8% margins, I think, because they operate all the infrastructure behind their content. So that's not the biggest gross margin you're going to see, but the growth is what's really impressing investors. And they have very good free cash flow yields, very good free cash flow margins. And that's what really drives a lot of the valuation when I get there. So just checking out the chat, and I see your comment on Baba, Bo. I will go over Alibaba next, and we'll dissect Alibaba. All right, so as I look at C Limited, there's a couple of pieces to it, right? I understand the business. I understand that they're in a industry that continues to get bigger. And let's face it, right? So many people are going online for entertainment, information, buying things, and so forth. That's not going to stop. It's just going to keep getting bigger and bigger. So C Limited is in an industry that I like. It's a part of the future. Other things that I like to look at that are very important is top line growth. The top line growth tells me, are customers really liking what C Limited is selling and the products that they have? And when you have 38% growth, back-to-back quarters, it proves to me that their product and their services are highly desired by the market. So that's very positive. This means this business is growing. It's getting market share. It's getting a bigger piece of the pie. So I look at that line. It's a very important line. I also look at free cash flow. I look at margins. When it comes to margins, C Limited is not the best. You want to look at great margins in their industry, look at Meta. Meta has terrific margins, gross margins, net profit margins. Their cash flow from C Limited is good. I do like the cash flow. I also like to look at what analysts have to say about a company. 13 analysts cover C Limited. The best price target, the most enthusiastic price target, $230 a share. The most bearish price target is at 100. Not too bad for downside. Overall, these analysts, 13 of them, the average price target is 35% above its current stock price. We also get in Stock Analysis, the website, they provide the forecast that these analysts are putting out there, saying this is what we think the business is going to do. And in this case here, this year they're going to grow nicely by 34%. Next year they're going to grow by 23%, 27, 16.5, and then 17.3. These are really good growth numbers. Those numbers are very impressive. Their profit is going to increase dynamically. That's another way of saying fast. And that looks really good. So when I look at this section I really like within Stock Analysis. It gives me that these analysts, I think looking at their information is useful to me, but they're not investors. They're putting a price target out there without putting capital at risk. And I still think it's good to look at, but I form my own conclusions about a stock when I look at evaluation, and I'm going to do that next. But I look at a couple of things. How many analysts are participating in the forecast? 32. It's a very high number. So there's more confidence in these numbers when I see that number of analysts putting their research into the mix. If it was only like 2 or 3 analysts, I wouldn't have as much confidence in the numbers. But with high number of analysts putting their research into the overall averages, it does give me more confidence that these numbers are probably useful. They're probably relevant and accurate. And these numbers look terrific. So that looks good. So far, C Limited, some pluses are it's growing really fast. The forecast is really positive. Some negatives, the margins aren't really good. One piece that should always be looked at in a business is you want to make sure that the debt isn't too high. These guys have $9.9 billion of cash and $4.2 billion of debt. So they have more cash than debt. These guys really don't have any debt. That's real positive. What we don't want is you see a business that seems to be a good one. But let's just imagine this business had $50 billion of debt. That'd be a problem because they'd probably be at a ratio, debt to EBITDA ratio, way above 3. And that would be a problem. You can't have a business have too much debt because even though they might have good ideas and a really good product, that debt is going to hold them back and also increase the chance that that business could go bankrupt. All right, so we've looked at information that was prepared on Stock Analysis, and they aggregate information from different sources. Now I'm going to look at information and research that I've completed, and that's what I'm taking you to. This is the model that I've completed for C Limited. Make this a little bigger. See if I can make this a little bigger for you guys. There we go. And going through this, overall, start with the conclusion. I think C Limited is discounted by 53%. How do I get to a 53% discount available on the stock? That means is I think each share is worth $288 per share, but it's being sold for $136. Well, first, I look at the value of their cash flows. And that's the most typical way that for like 100 years, investors, long-term investors, have gauged the value of a business like C Limited in most businesses based on the free cash flows they're going to produce. How much cash is going to be driven into the balance sheet and increase the value of the business. So I created a forecast based on the cash flows that they produce. I'm growing that forecast year one by 30%. And then I'm taking a conservative route of them growing cash flows in years 2, 3, and 4 by 20%. All these numbers take us up to year 4. And then terminal value is all the cash flows past year 4 that are into the future. Year 5, year 10, year 25, everything in the future that would be included in terminal value. This is in a very good industry that continues to expand, get larger. So my long-term growth is better than let's say a mature industry that isn't growing at all. That would probably be 3% growth, maybe even 4. Next, I take a net present value of all those cash flows. And the net present value, here's the calculation, net present value. If you don't understand what net present value is, it's really important that you get your head around that particular metric. And you can use ChatGPT or you can use Gemini and have it explain net present value, NPV. And it'll explain what it is, why it's important. But if you're going to do investing in stocks, you're in the finance realm. And that is a important lesson that you need to really master. You need to understand net present value. I'm going to add cash and take away debt. And I brought these straight from their balance sheet. So I get what I call equity value, which is the net present value of their cash flows plus cash minus debt. And it's much higher than the market cap. It's actually 59% higher than the market cap. So the cash flows for this business are really good. The profits are also very good. And the profits of the business expected for the next full years are $4.66. We give them a high PE because they have high growth. And I'm going to grow those profits by 20%. I like to blend these two numbers. This one gets 2/3 of the weight. This one gets 1/3. So I get to a 53% discount on C Limited. I am buying into C Limited. And the other question that was asked by Magical Self is, what kind of position size would I have with C Limited? And the answer is that I would have a small to medium-sized position on C Limited. Here are the reasons why. Now, a big position example would be Google. That's my biggest position, and that's a very big position, and I'm very comfortable with that. My conviction, confidence, comfort level with Google is very high. Google's a US-based company. I know it very well. C Limited is not a US-based company where I live. It's outside my home country. So that's risk factor number one. Second, C Limited operates in businesses that I understand, but I don't have a lot of personal experience in, whereas Google is in some industries that I have personal experience in. So that's the second area that I'm not as confident around. So that reduces position size. So it's out of the country. It's also doing business in some areas that I'm not quite as comfortable with. The third factor would be those margins. This is not inherently a super profitable business like a Meta. And therefore, that'd be another reason why I would keep my position in C Limited as a small to medium-sized position. Right now, I have a small position. I dollar cost average into stocks, and I bought more shares in C Limited today because it was down. For a while, it was down 2 or 3%. So I took the opportunity and bought more shares. I would probably buy up until I had $30,000 to $40,000 worth of C Limited and probably hold at that level and see where that investment takes me. And I would continue to study each earnings that would come out for C Limited to see if their fundamentals continue to go down the path that I expect. They're better or worse than I expected. And I would also see if the story behind them, which is this is going to be a high growth company for Asia. They're also doing some business in Latin America, but I think Asia is going to be their principal market. So that's C Limited for Magical Self. And I'll check to see if you have any questions and also check on the chat. Thanks for asking about C Limited. We're going to move to Alibaba next, which was requested by Bo. Or I should say he was interested in my comments there. So we're going to move to that one. And so Bo, big discount on C Limited. Yep. One thing I would say about Chinese stocks and I guess Asian stocks is that you'll see bigger discounts. US based companies are valued, I would say, at a premium price. And the same company, if it was in China or in Hong Kong, Singapore, the same company would probably be 40% lower, just like 30 to 40% lower. It's just, it is what it is. And that's been the case over the last 3 years. For a while, Chinese stocks really had a lot of momentum around 4 years ago, but that momentum left and it never came back to the extent that it was in the market in 2021. So that's the way I see it. All right. So looks like JVM. Good question on Nebius. Nebius is a data center company doing cloud services, AI services, and giving or selling their services, renting out their infrastructure to companies that want it. I could cover that $5 super chat, or you can become a member and then I could tackle that. So do they have less upside in China? So there's two answers to that question, which is from a business perspective, are they going to continue to grow and flourish in Asia? And I think they will, because especially China, China's economy is growing faster than in the US. So I would actually believe that growth rates are more sustainable in Asia than they are in the US. So that's from a business perspective. But valuations, you look at the most valuable companies, they tend to be all US, right? And that's the comfort level of the market. If they're headquartered, operated in the US, traded in the US, those are the highest price stocks. And then we go to other parts of the world and we see some great companies that are priced differently. In Europe, you might see Nebius as an example, or ASML out of the Netherlands. You might see some other stocks in Europe that are terrific businesses. And when you go to Asia, you might see Alibaba, which we're going to look at next, C Limited, and other stocks. But I would put it out there that you need to or I would say that I need to recognize that if I invest in China, it's just going to come with a higher discount because investors treat it as it's just more risky when you're invested in Asia. And I do increase the discount rate on C Limited to recognize that it's out of my home country. A good business here in the US, like a Google, would probably have a 7.5. And this one has a higher discount rate to compensate the investor, me, for the additional risk that I'm taking. So that was C Limited. Let's jump into Alibaba. Alibaba announced their earnings this morning and the stock sold off. And I looked at the stock twice. I looked at it initially. It was early in the morning. And my first run through was negative. I'm like, man, these guys are not growing very fast. My second run through, I saw some things that I didn't see the first time. So my observation became more positive. And I ended up buying more shares. I own a big position of Alibaba. This is one of the biggest market cap stocks, if not the biggest, coming out of China. I'll explain why I have a big position in Alibaba and why it's different than C Limited. So Alibaba, big market cap, $350 billion of market cap. Excuse me while I get a drink of water. Revenue is much higher than C Limited, $142 billion of revenue. These numbers are in US dollars. When we go to some other data points, we're going to look at the Chinese yuan based numbers, but I'll make sure to point out when we're looking at dollars versus the yuan. P ratio, 21.6, forward P 17.5. Alibaba is a conglomerate that has, it's similar to Amazon, not quite as big as Amazon, but similar. They have an e-commerce business, they have a cloud infrastructure business, they have a financial fintech business, and all those businesses together make up that big revenue number. They are a strong buy with this discount. They have been a very good stock this year. They were sold off, as mentioned, in 2021. Chinese stocks were the cat's meow. The growth rates in China were far better than what we're seeing in the US. So investors like Charlie Munger were very positive on Chinese stocks, and Chinese stocks really rose. But at a certain point, I think the market just became more concerned with Chinese stocks, and those stocks sold off. So this stock really settled down, to say the least. But buying at the right time and buying into quality is always in season, and this stock has done really well in 2025. Some good news around it is they have the biggest cloud infrastructure business, similar to AWS, Microsoft Azure, Google Cloud here in the States. These guys are the biggest in Asia. They also do business with like India and the Middle East, and they offer less expensive infrastructure services than their competitors that maybe are US based. So Alibaba, the stock's been doing well. Let's get into what they announced in their earnings, what I liked and didn't like. And it looks like we're getting a lot of comments. Thanks everybody for joining. I'm going to catch up on comments in a bit. Let me continue on Alibaba, finish this analysis, then we'll get to the comments. The earnings that were announced today showed that they grew at 4.78. And initially I thought, that's just not fast enough. Why are they not growing faster? They also, when I looked at their profitability and cash flow, it's been a little rough because they've been spending a lot of money growing their business, especially in that data center. So when we look at trailing 12 months, it doesn't look as good. Their gross margin looks okay, but when we go to operating margin, not okay. It really went down. Profit margin went down. So I think that's why the market sold off Alibaba, because this year they are investing a lot in their business, and they're not necessarily trying to make their numbers look great for their earnings. So that's where I did see some yellow flags, some red flags, like, hey, what happened here? But when I took a closer, or maybe looked at it from a different perspective. First, there's 13 analysts covering it. A lot of them are quite high on Alibaba. But when I look at the forecast that's provided on Stock Analysis, this year, yeah, they're not going to grow all that well. Their profit is kind of under stress because they're spending so much money. But as we move into the next full year, their fiscal year ends March 31st. They're going to grow much faster. 11.5, that's really good growth for a big business. 9.4, 7.7. And their cloud business is growing by 36%. It's very good, very fast growth, much faster than AWS or Microsoft Azure from a percentage standpoint. And their profit's really going to jump. And we have a lot of analysts putting their forecast into these numbers. These numbers are averaged out, and it looks like the future looks really bright for Alibaba. So these numbers are the numbers that swayed me to actually look at the business and have an optimistic outlook, more positive outlook on Alibaba looking forward. So let's kind of recap Alibaba before I go to my valuation. First, do I like the space? Absolutely. Do I like investing in China? Yes, because the Chinese economy is growing faster than the US economy. It also gives me an opportunity to diversify. Most of my assets are in the US. I'm glad they're here. But it's a good idea to diversify to other regions of the world with a portion of my portfolio. Alibaba is the biggest stock that I own outside the US. So there's some good reasons to invest in Alibaba and in China for me. All right, so we went over growth rate on the top line. This year didn't look great, but next year looks really good. Their free cash flow is explainable why it went down a bit, but we think it's going to get better. We didn't look at the balance sheet. Let's take a look at the balance sheet. It looks like Mark Stan 890. Thank you for the super chat. I'm going to get to that in a minute. Bear with me for a second. So, balance sheet, they have $52.47 billion of cash, $39.55 billion of debt. So they can pay off their debt. It'd be a big check, but they could pay off their debt immediately. So the balance sheet's very good. All right. So that's all the external data. That's data from their earnings report. Now let's take a look at a valuation for Alibaba. This is the valuation that I calculated and I updated this morning. Overall, I think there's a 34% discount available on Alibaba. I think each share is worth $238. So I'm on the upper end. If you recall those analysts that were looking at Alibaba and putting price targets, I'm with the group that's optimistic about Alibaba. I really like their future forecast. And each share is being sold for $157. Since the stock, or I should say the company, is spending a lot of money in their data center, buying, semiconductors, putting equipment in that data center. I'm not going to take the trailing 12 months free cash flow and use that to forecast because this year is just pretty low of a number. So instead, I looked at the previous 5 years, full years, and averaged the number and had that be my starting point. I think that's rational. Now, the company is going to be bigger in the future, so it might be a little bit of a conservative play. That's all right. I'm going to grow cash flows by 10% in the first 4 years. And since they're already big, the long-term growth will be 4%. And everything else kind of flows. 29% discount compared to the cash flows. 43% discount compared to profits. So I bought more shares of Alibaba today. I own about $100,000 of Alibaba. That's not the biggest position in my portfolio. That would be maybe a top 10 position. And I'm willing to take that up higher. Alibaba is a solid business. It's probably the most important publicly traded company in China and in Asia. So that's my analysis of Alibaba. Hopefully you guys found it interesting. And if you have any questions, I'll take those. All right, so let's go over the chat. So Mark Stan, good to see you. Soccer player there. You want to take a look at two stocks. Dave, that's a new IPO stock, and LMB. Glad to do that. We'll go over Dave, and then we'll go over LMB. I do have a valuation for Dave, and LMB is a new one, but we're going to create a valuation from scratch. That'll be a good flow to follow. Thanks for joining. Appreciate you. All right, so let me catch up with some members that came on. Smith and Wesson. So yeah, so let me get you my email. It's victorhinvesting@gmail.com. I know you're a new member. Thank you. You get me your email address. I'm going to give you access to a shared folder. And in that folder is going to be this valuation model. It's a working model. And you're going to get invitations to 3 different investor calls where we talk on a video conference. And if you attend those and you want to work through the model, that's something we can do on the call. You could ask me questions. I'm also going to send you an invitation to the Discord because you qualify for that. And you can join Discord, and you can ask me questions on Discord. You can ask me questions on email. You can ask me questions by posting on videos. However you want to get to me, that's fine. Your name will show up differently when you go through YouTube. So I'll know that you're a fully paid member and you'll be good to go. And the last thing is you're going to get access to member-only videos that I'm publishing. I published 3 or 4 today, and each day I publish those out. And thank you, Smith & Wesson. Really appreciate your membership. And I'm glad we connected. I try to make that available. Like I post on the YouTube channel, also in the instructions when you become a member, it's in there, but I don't think YouTube does a perfect job of telling people what to do next, because you're not the first one that has had to chase me around a little bit to get my email address, but here you are. All right, my man, Tony. How do you assign discount rates with the company? Say high revenue growth, but not huge amount of revenue. That's a very good question. So, and we're looking at Alibaba on the screen. See how their discount rate's 8.5. If we looked at Amazon, it'd be 7.5. The reason Alibaba is more because it's out of my home country. But as we go to C Limited, it's smaller. And if we go to a really small company, like a smaller company is JD, the smaller the business is, the less it's known, the bigger the risk. The higher the risk, the higher the discount rate. In finance, you've probably heard the term risk adjusted. The higher the risk, the higher the return. And what investors, these professional investors, are trying to do is to get the highest rate of return with the lowest amount of risk. So as I work with discount rates, I'm using my logic and observing, what business am I working with here? Is it a small business? Is it in a very tough industry, maybe with a lot of competition? That's risky. And that would drive a higher discount. Like I think on Oscar Health as an example, Oscar Health is a smaller business in healthcare. And I believe I have an 11 as a discount rate. I like Oscar Health. I think it's a good business, but they're small. And they're going to go up against some big forces like United Healthcare, Elevance. If you looked at a United Healthcare, it's a 7.5 discount rate. So the smaller the company, the higher the risk. Especially if they're growing really fast like Oscar. You want to temper your enthusiasm. It's good to forecast Oscar Health that, hey, they're going to keep growing really fast. Perfect. Just adjust the risk factor, the discount rate, because you and I deserve a higher rate of return if we're taking a higher risk. So that's how I go about that. It's a very good question. And as you invest, I know you're a younger investor. You keep improving your skill set, your knowledge base, your wisdom, your experience. And I encourage you to get into industries that you can understand. You don't have to be an expert. You need to understand how those industries work, what their fundamentals look like, so you could attain that wisdom, that skill, so you can make those calls like, hey, Oscar Health, I've invested in health insurance payers for 10, 15 years. So I have the experience of being a long-term investor with United Healthcare and a number of them. Having said that, I can operate in healthcare, health insurance payers, and I could then make decisions on the discount rate. So as always, I know, Tony, you're an attendee to the member calls. Happy to take that on and beat it up a little more and explain it even more. Up 95% on Google. Anxious hamster. Well, that's music to my ears. And what I want you to take away from the Google experience is you made good money on Google. How did you do it? What was your process? And go do it again. Go do it 3 more times in the next 12 months. And then that's where, man, that's what I want from every person on this live stream is 5 years from now, you're 25 times better. And when you invest in like a Google, you go back this year, you understood, the situation from a fundamental perspective, you made the investment, you succeeded. Go back and what was the lesson? How did you do it? How can you do it again? Okay. And from the stocks, not all of them are going to be winners. You're losers. Go back, do the same thing. Because that's what I try to do. I'm looking for the next Google. Google was the decision I made 7 months ago, 6 months ago. Great. I think it's going to keep going higher. But now I'm thinking Meta is going to go up. I'm thinking there's probably 10 stocks that I'm seeing what I was seeing with Google. Now it's time to go make money on those. So great to see you, anxious hamster. And I'm glad you made a nice return on Google. I never provide investing advice. Everything I ever talk about is just my experience as an individual investor and my research. And you can take that experience and research and do what you like with it. I appreciate you joining. Good to see you, Bo. Man, you're a regular, and I appreciate you. All right, Smith & Wesson, we got you all squared away. Cool. Good to hear that, Mark. Thank you, sir. You're welcome, sir. I added Applovin, and it went up in value. Let's cover Applovin after we cover this string of stocks here. I like Applovin. Applovin is fast growing. It's a good example. And then last, man, we got a good chat going on tonight. Meta became a really good opportunity really fast. They announced their earnings on the 28th, and the stock dropped literally 20%. Well, the market's done that before with Meta, and I've made money on every occasion that the market's done that, and I'm in the mood to make money on Meta once again. Let's get into Dave and LMB. So Dave is a financial services company. I like what they're doing. They're like a new gen company that is doing things a little bit like SoFi. Financial services, the experience for the consumer could be quite difficult, arduous, challenging, lengthy, frustrating. And Dave is trying to make it fast, easy, accessible, use technology to make the whole process, just a better experience for the user. I get it. I like it. These guys announced their earnings on November 4th. What's been happening with the stock? So this stock made a move coming out of April. We had the fears around the tariffs. Just about every stock went down. And these guys made a big move, going from $70 a share, tripling to $210 per share. Whew. Man, hang on. Buckle up. Now, I'm not currently invested in Dave. It's been going sideways up here, and you could make some money buying at the right times. And look at that. We just had a nice little short-term rally going from 175 to 209. I'm a long-term investor. I like making money in the short term, and it's interesting. Like I bought NVIDIA near its low this morning, and I probably ended the day up 3%. But that I'm not after 3%. I'd like to make 100%, 200%, 300%, and I do that over time. So that's my intent. That's my goal. That's my North Star, is making a lot of money down the long road. And Dave, it doesn't interest me. Now, there's other investors. There's some investors that like to swing trade, buy here, sell here, and so forth. Hey, great. If that's what you like to do, go for it. I'm going to show you fundamental analysis from the perspective of a long-term investor. So this guy's been kind of going sideways. I like their business overall. Let's take a peek at their website. So this is Dave's website. See how they're up to $500 in 5 minutes or less. So these are loans. I think cash advance loans. They do banking, checking. So these guys are like a SoFi, right? You can earn on your savings with them. Okay, so no hidden fees. They have a very digital experience as opposed to the classic banks like the, Chase banks and so forth. They have kind of an old school experience. All right, so Dave, we saw where their stock's at. This is a $2.84 billion market cap company. So it's a small cap, less than $3 billion. Revenue is $491 million. So one ratio to look at is how many times revenue is one paying for this business. And you'd be paying a little less than 6 times, which isn't too bad for a growth company. And I know Dave's a growth company, so that's not a bad ratio. P ratio doesn't look too bad. Again, I'm expecting these guys are a growth company. Unless things have changed, I probably looked at these guys 3 months ago. Analysts think there's a discount of 34% available on the stock. All right, so I like their industry. I like what they're doing. I think they can innovate within the space and grab, an adequate amount of market share. Other businesses have done it, like SoFi, Robinhood. I can go down the list. Now, I like their idea. Is their idea working? Are they growing by high percentages? Well, for the full year, the answer is yes. Let's take a look at the quarterly. The quarterly is telling us, last quarter's what's been happening. It's actually gotten better. Almost 63% growth in the last full quarter reported for September 30th. That was reported on November 4th. Why didn't the market like that? That's a great number. The quarter before, 64, 40. So you see how this number is accelerating when you look at the percentage growth, and the number is getting bigger. That goes to show that customers like the Dave services offering, the Dave website, the Dave experience. And the customer likes it. More customers are coming to Dave. They're buying more products. They're doing more with Dave. That's what it tells me, top line growth. All right, we got that settled. Now I'm going to go to the trailing 12 months. And this column is going to give me the 12 months that are summed up to end on September 30th, 2025. Collectively, they've grown 53.8%. Very good. So these guys, one thing I'm going to notice here when you work with financial institutions that resemble banks, you have to see, are they reporting their numbers as if they were a bank, or are they charging per transaction and are reporting numbers pretty much like a commerce company, as an example. In this case here, I'm going to go to their investor page in a bit and confirm, how are they reporting? Do they classify themselves as a bank or not? Because it's important, because we use different valuation paths for Dave. I want to show that to you step by step. I've already concluded that because I have a valuation for these guys, but I want to kind of show you each step in the process. So here is their revenue. Total revenue was 491, gross profit at 351. So these guys are transaction based. Okay. If it showed numbers that were breaking out the net interest margin, NIP, that would be a bank. So these guys are charging per transaction. When you look at those buy now, pay later companies, they're doing the same thing. They charge a 3% transaction fee to the consumer, or actually to the vendor, to the seller of the product. And that's their margin. And then they want the customer to pay them back over the course of 6 weeks. Okay, so that's a good overall profitability. When we look at their profit, 71%. And you see how these numbers are getting bigger. Okay. The numbers are getting bigger because Dave is getting larger. As you become larger, you get greater scale. You don't have to hire the same people. You just hired a person. They add to your cost structure, but now you're able to take more customers on and your gross margins go up. Operating margin looks very good. Profit margin looks excellent. These numbers are very good. The numbers on Dave look terrific. Okay. Excellent numbers. So you have high growth, profit, margin, cash flow. I'm good. Dave's a small company, but the numbers look fantastic. 6 analysts cover Dave. One analyst is way up there at $345 per share. One analyst is pumping the brakes at $175. But on average, they're saying, hey, this thing's discounted by 34%. I'm really liking the revenue growth. I'm liking the profitability. So let's keep going here. So this section here, this financial forecast. Remember, in investing, we invest by looking forward. Over the next 12 months, what's this business going to do? Over the next 2 years, what's it going to do? We do not invest by looking at the last 2 years. Hey, this business has been great for the last 2 years. I'm going to invest because I think they're going to repeat. Well, they may, but you're going to make money or lose money based on how they do over the next 12 months. So we're trying to get the best prediction or information on what's going to happen over the next 12 months. So that's why it's really important to always think about the future. Okay. And the now is 2025. This is what's been going on. We went over their growth. Growth looks stupendous. But these analysts are thinking the growth is going to slow down drastically. Okay. Now that's a drastic slowdown. Okay. And I can understand the market not being indecisive on this stock. If it goes from growing 50% per year, 60% per year to 15, whoa, that's a big slowdown. The profits are going to expand nicely. Now, in a stock like this, we have 9 analysts doing their forecast, which is a decent number, but not a great number. And what I'm going to do is I'm going to go to their investor page. I'm going to look for a couple of things. One of them is going to see if they're providing a forecast of what they're going to do next year. Typically, if they provide a guidance on the next year, that's very useful to us. So this is the earnings they reported on November 4th. Here's their earnings release, their presentation. All right. So we know that they grew really well. That's great. So let's go with, let's keyword search for guidance. Here we go. So they raised their guidance for 2025. Now, that's basically raising the guidance for the fourth quarter because they've already reported the first 3 quarters of 2025. So it's good that they have that momentum. 25, and here's the full year guidance. Okay, got it. So they're not providing 2026 guidance. That will be provided when they announce their fourth quarter and their full year 2025. They announced their earnings on November 4th. So if we add 3 months to that, it's going to be about February 4th when they announce their full year report for 2025. So this is where we investors make our money. One of the key decisions. Do I believe they're going to do better or worse than 15%? And then let's call it 9% the year follows. I believe they're going to do better because this is a heck of a run they're on. And their growth is accelerating, right? They're going from 40 to 50 to 64% growth. That's terrific. How can a business that has that kind of momentum, and they're not the biggest business in the world, have such a slowdown? I'm thinking that they're probably going to grow, 30% next year, maybe even 40. And if that becomes more of the story behind Dave, this stock's going to fly up. And we are dealing with a stock that is not overbought, right? We have a stock that's kind of been hanging out around $200 per share since May 2025. So that's, call it 6 months. It's been hanging out at 200. And this thing IPO'd. I stay away from IPOs because they tend to do this. But now this thing's really rocketed up. They deserve a good price appreciation. But boy, this talk about a price appreciation. This is maybe a little overdone. And that's why the market's kind of consolidating, waiting to get more information. So let me show you my valuation of Dave. And then I'll form some conclusions on what I plan to do with Dave, because this is a stock that I'm following. I do this for the love of the game, but to play the game and make money. So I need to update my numbers, and we'll do that together here. Last time I updated them was August. We are in November now. So let's update these numbers and see where I land and see what we want to do with Dave. So this is a higher risk stock because it's smaller. It's growing really well. 8.5 discount rate. I'm not going to change that. They've been growing really well. 25% growth rate. I think that's still good, but let me think it over for a bit. What is their trailing 12 months free cash flow number? And that is $238 million of free cash. That's going to improve the valuation because the last number was below 200 billion. Okay, so I updated that. Let's update our cash on the balance sheet and debt. This company, I may have forgotten to cover it, but we can do that now, has more cash on the balance sheet than they do debt, showing that this balance sheet is in very good shape. They have plenty of cash on the balance sheet. They could pay off all debt. Looks good. So at a 25, and let's say they are going to slow down a bit next year. I think it's a small business taking over an industry and grabbing the younger consumer. That's like, man, I don't want to go do business with Chase or Bank of America. It takes like an hour to do anything every time I go in the bank. I'd rather do business with a company like Dave, where they do things quick, process is fast, it's fully digital. And the younger consumer, they've been on iPhones and computers since they were 2 years old. Where they're digital natives and they like businesses like Dave. So I think they're going to grow better at a 5% rate. All right. So those growth rates I'm comfortable with. And the net present value on their cash flows is really high, $11 billion. I could even increase the discount rate and say, well, they're a little risky. It still gives me a really nice discount on cash flow. Earnings per share, I need to update this number. And the earnings per share is going to be for the next full year. What does that number look like? Well, the next full year is going to be 2026. That number has improved. This is also a confidence builder. The last time I looked at the forward number, it was at $7 per share. Now it's $9. So the numbers are improving before our eyes. Now, a business that's growing the way they are, they deserve at least a 24. And their growth rate on that number, 15, is fine. Okay. 63% discount available on Dave. So I'm a buyer of Dave. This is a good looking situation. When is the perfect time to buy Dave? I don't know. That's why I dollar cost average. But Dave looks good. Looks really good. This is a buy in my book. Let's go find Dave on my watch list. I want to make sure I note that I like the stock. And not a watch stock, it's a buy stock. I like what I'm seeing. I'm liking the improvement in their numbers, right? You saw as I updated the numbers on them, the earnings per share number improved, the cash flow improved. Man, this business is really getting off on the right foot. It's a young business, but it's doing a terrific job growing its customers and making a lot of money along the way. So Dave looks fantastic. That's my analysis on Dave. So thanks for sponsoring that super chat, Mark. Let's head over to LMB. This one is a new one for me. So Limbach Holdings. Limbach Holdings operates as a building systems solution company in the U.S. It operates through two segments: general contractor relationships and owner direct relationships. The company engages in the construction and renovation projects that involve primarily include mechanical, electrical, plumbing services. It also provides professional and consultative services, replacements, and retrofit solutions, rental equipment solutions, maintenance, repairs, and so forth. So they're in industrial building products. All right, let's take a look at their website. How does Limbach present themselves to the world? All right, so this is what they do. You got air conditioning problems, you got heater problems, you would call a company like this to make your home comfortable, or maybe your office space. You want it to be comfortable so people work hard and do their thing. Okay, so they do their commercial business, all right, residential. Now, the one area that's really been, pretty hot is anybody in the data center. So these guys are operating the data center. It seems like it's not their primary business. They're doing stuff that you would typically find them doing, which is commercial office space and spaces where people work, homes, and things like that. Okay, so we're good with that. Let's take a look at their markets real quick. Here we go. So they're hospitals. They do services there, cultural entertainment. So arenas, universities, lightweight manufacturing, data center. So they're in the data center, but it's not their only thing they do. Life sciences, so laboratories, and then other. All right. Okay, so let's keep going. So this is a services-based business. Let's take a look at it. So these guys are a small cap company, $802 million. Okay. Over the 1 year, they've been selling off. They've gone from 150 down to 70. Now they caught a bid and really flourished, but they've really given up a lot of that stock price. Okay. All right. 802 million. This is a very small cap. Revenue 603 million. Less than 2 times sales. P ratio 22.8. Now this is in a different industry. Okay. This is not Dave. This is not SC or Alibaba. These guys are services. And I'm going to point quickly to why I don't love these businesses. That's a nice way of saying I don't like these businesses. Their growth isn't setting any records. These are full years. Okay. And you see that their growth hasn't been all that exciting. It's certainly not Dave that's growing at 64%. The other piece too you think about, right, is we're going to look at their gross margins and I'll explain a little more. Gross margins, 27.8. Dave was already at like 70%. If you look at SE, they were at 40%. If you look at businesses like Reddit's at 90% gross margins. So why is this gross margin number lower? Simple. When a customer calls in and says, hey, Limbach, I want you to install a new air conditioner in my home. Sure. They have to send an employee that's well paid in a van, and they pay that employee a very good wage. The employee does a fantastic job. I'm happy as a customer. They're happy they got a sale. The employee's happy that he's employed. But as they grow and they continue to grow, they have to hire more people and pay more people. So a lot of the profit, the gross margin, is being spent on salaries and incidentals, but mostly salaries. And it'll never get much better than this, 27.8. That's probably the best year they've had in a long time. And that's why these businesses are not worth what other businesses would be worth, is that they'll never be a Meta. They'll never be a Google. Like Google search. They've built a platform and now it's worth $1 trillion. Visa, they built a network and they have very few employees that have to administer it, and they make 90% gross margins. Those are the businesses that make a lot of money. Those are the businesses that build a lot of wealth for investors like you and I. This one is going to have a low ceiling. It's going to be like, okay, I can make a few bucks here or there, but let's keep going. So I explained the principal thing that I don't like. I also don't like that the growth has looked a lot better in the last quarter, 37.8%. I'm going to take a quick peek and see if they acquired a business, because if they acquired a business, then that would explain the growth. If they didn't, that's a really impressive growth rate. That's really cranking up the growth. And I know that Mark Steen asked about this. Let me ask you, are you aware of why they're growing so much faster now? Do you know what's behind that growth? And I'll try to keep an eye on here. And all right. How you doing, Trader Prad? I attended Trader Prad's live stream earlier. All right. So I'm going to keep going. I don't see any comments. But Mark, if you know what caused this growth right here, in the meantime, let's put on our investigative journalist hats on and see what's going on here. See, did they acquire a business? That is what I want to know. If they acquired a business, it may be a good acquisition, but growth through acquisitions is not as good as growing organically. Okay. Presentations. Let's look at all their news headlines, press releases. Okay. They announced their earnings. We knew that. Limbach acquires Pioneer Power. So here's the acquisition. So Limbach, okay. So they acquired a business. So that's why we're seeing a jump in revenue. And it's not organic. So it's not as good. If a business like we looked at Dave, that's organic. They're getting more customers like the service. They get 100% credit for that growth. When you grow through acquisition, you're stepping up your revenue, but you bought it. It's not like you acquired new customers because they loved your service. This seems like a good business. It's just be aware that this growth is not as good as organic growth. All right. So they are doing well as a business in general, right? Last 5 quarters of growth, they acquired a new business. Free cash flow is a little light, right? So for free cash flow, we'll do a valuation on this company, but it's a little light. So margins are low, light on the free cash flow. Let's take a look at their debt. Now, these guys would not surprise me if they have some debt because they just acquired a business. And look at here. They have a little less than 10 million, excuse me. So used to saying billions. $10 million in cash, but they owe 83 million in debt. They probably acquired that business and had to go to the bank and get a loan. Debt to EBITDA 1.2, not a problem. They can handle that kind of debt load. So it's not a problem, but they just have a little bit of debt. We'll decrement that from their value. So balance sheet's okay. We have 2 analysts covering the stock because they're such a small business. Good news is they're both very positive on this business, thinking that they could have a very prosperous future. These analysts look at only the profits, okay? And that's why I like looking at cash flow and profit. That way I really understand. And if I took the top 10 most valuable businesses on the stock market and I looked at their cash flow, you're going to see great examples of high cash flow generating companies. So if you need to convince yourself of why do we look at cash flow, go look at NVIDIA, go look at Google, go look at Microsoft, Apple. They've maintained their high valuation because their cash flows are just insane. They do over $100 billion of free cash per year. That's why they're that valuable. So let's go find small businesses that generate a lot of cash because they're going to go up in value. Okay, let's carry on. So they're expected to continue to grow. 5 analysts are covering this little business and putting in their analysis and their research. Not a lot of analysts, but a couple of opinions. They're supposed to grow nicely. That looks good. And earnings per share will expand. That expansion looks good. All right. So this is where the rubber hits the road. What do I think this business is worth? Now, what is a good compare? Let me look at all the stocks I'm watching. This is more an industrial stock that does services. So they might be like comfort systems. So let's go look for Fix. We can kind of copy that example and also use Fix as potentially a company so this is a company that does similar things. They install air conditioning and that kind of stuff. All right, let's keep going here. We're going to do a valuation from scratch. Let's do this. Now I'm taking my time, guys, on these streams because I really want this to be kind of a process of learning on the evening streams going forward. And so hopefully you guys appreciate the speed that I'm going and the detail that I'm covering. It's not so that I frustrate anybody. It's that I really want this to be a learning exercise, and I want to explain things thoroughly. All right, so we are dealing with LMB, and the company name is Limbach. So this is a tiny company. The industry is not bad. Like, it's very reliable. People are going to want air conditioning and heating. Can't do without it. So, but they're tiny. So I'm going to move this to 9%. Okay. All right. So what is their free cash flow number? I'm going to refer to a different screen you guys can't see. And I'm going to look on stock analysis and take a peek at the trailing 12 months free cash flow. And we have and let me tell you why I'm not understanding what stock analysis is showing me here. And stock analysis is a very good tool, but not perfect. So, okay. So for some reason, okay, error on my part. Moving on. I was looking at the free cash flow from Dave. I forgot to update the other screen. So back to looking at the free cash flow for this company. It is 31 million. $970,000. So that's here. Now, when we looked at their forecast, because now we got to say, how's it going to grow over the next couple of years? Well, remember that forecast that a couple analysts were willing to share their research and say, we think they're going to grow. We're in this year. Next year, they're going to go by 15, then by 10. Okay. Okay. So I'm going to grow by 9%. I think that's a generous number, at the same time safe. I don't want to get, too optimistic. So I'm growing the trailing 12 months in years 1, 2, 3, and 4 by 9%. And it's going to obviously compound year after year. Terminal value is all years after year 4, 947. The intrinsic value of those cash flows, $745 million. What's our cash on hand? Well, that is $9,820,000. Total debt, $82,750,000. So you see how the cash flow just isn't there. It's just not a high cash flow generating company. And to show you an example, just real quick. So Reddit, I'm sure everybody knows what Reddit's all about. This is a young company, new, growing fast, high free cash flow value. And even though the stock's really taken off, it still values. So again, when you look at a big cap stock like an Apple or like a Google, what makes them so valuable? Study their free cash flow, study their forecast of free cash flow. And you see that investors are really keen in on that number. Now, the analyst, they like looking at earnings per share because that's what's reported by the businesses. That's what they guide towards. And some investors like Charlie Munger, the great late Charlie Munger, who invested till he was 99 years old. What a freaking rock star. And he made billions of dollars. He was worth like 80 or $100 billion when it was all said and done. He hated earnings per share. Some investors just despise it because management could influence the number. Now, these guys, where do we go with the PE? Not a very high margin business. So I can't give them a 24. The growth is okay. So I'm going to be generous and go with 18. And we're using 409, which is the 2026 number that is being provided by analysts who are doing a forecast on this company. And after that, they're going to grow by 9.5. So I'm going to grow it by 7. So this business, in my opinion, is priced 44% too high. And really, it's the free cash flow. We're not going to cash flow. And I could show you 20 businesses of this type. They never become a big cap because of the margins. And it kind of makes sense, right? If a big part of the revenue ends up in paychecks to your employees, it's a good thing for the economy, but it's not a good thing for the overall value of that stock we're buying. Whereas a company like a Meta, the per employee per $1 million of revenue is really advantageous to Meta. They can grow their user counts by 20% and probably not add many employees. And all that's profit because they charge customers to advertise on Meta. So that's where I land on Limbach. We just did a full valuation from scratch, and hopefully you found it interesting. So let me pop this guy over here. Then we're going to move on to the next stock. It is great to have you on the stream. Thanks for showing up and sponsoring 2 stocks to review. I appreciate it and welcome you back. Welcome you to ask questions. And let's move on to the next one. All right. So where am I at here? Okay. So I got Limbach. I'd made myself a note to come back and update it. Let's get back to this chat. See what my next stock is going to be. I think we're going to go to Applovin next. Let's take a look here. So we're going to go to Applovin. Magical Self was curious about that. Applovin is a bottle rocket kind of stock. I'll show you. So here's Tony. Can't argue with buying Amazon. Meta's solid too. Paul, good to see you. What is the best stock between now and the end of the year? Okay, got that. So basically, for the next day and a half of trading left in November and then December. All right, I'm going to think about that, but I'm going to answer that after Applovin, Paul. Then we got, you want to look at WHR. Batten, good to see you, buddy. WHR, I think, is Whirlpool, right? And Whirlpool, you know, I've spent a lot of money on appliances. So I wonder if they make a lot of money. Okay, so DJ, good to see you. Absolutely. Let's take a look at Bill. Bill's a solid little company. The market doesn't give enough credit to these software companies. Glad to look at it, DJ. So Whirlpool's at 52-week low. Okay, we'll take a look at that. Okay. All right, perfect. Anxious Hamster, welcome to the channel, sir. Thank you for joining. I appreciate it very much. Let me know if there's something you want me to cover. Thank you. Trader Prad, if you guys want to see an awesome streamer handling analysis, technical analysis, and if I have it right, he's He's a short-term trader. And I'm in awe of how quickly he has to make decisions on stocks. I like having a big picture, really looking for a long-term gain. And he really goes with a short timeline. Check out his channel if you'd like to see that kind of content. All right. We've got, man, Zim. That's a rough one. Let me know if you want me to look at it, buy a super chat, or become a member, and we can take a look at Zim. That one goes all over the place. Very volatile. They could have a great earnings and the stock goes down. They pay a big dividend. So there's a lot there. And Zim is tricky. You could get lured by that high dividend and then lose money on the stock. LMB has taken a beating lately. And as I showed, just the valuation of businesses of that type just doesn't have, it has a low ceiling. So how high could it go, right? I think that's what investors are looking at. Position size for Dave and Applovin. So on Dave, that would be a small position because it's a small company. As I get more comfortable, maybe increasing it. But even with Robinhood, I didn't put a ton of capital into that. I put like $25,000 into Robinhood, and that investment's worth $230,000 now over a couple of years. And so the capital at risk was $25,000. That's a medium-sized position, right? And it really flourished. So Dave could kind of follow those lines if it started to perform, right? Maybe I'd go $5,000, give it an earnings report. If it keeps doing the right things, go to 10, go to 15, go to 20. And keep feeding it if it keeps winning. And then I'll comment on Applovin because I'm an investor in Applovin. I'll give you that. Yeah, Shadow Guy. Good to check in. Good to see you check in. Thank you. Yep, here it is. They did acquire a new business. Now it's back to Limbach. Man, we are rocking tonight. We got all kinds of stuff coming at me. Thanks, everybody. I appreciate you coming in. Oh, all right. So, yeah, I got plenty of time. Okay, so we're going to put Rally and Mountain. So Mountain, I have a valuation on, and that's a pretty neat business, man. I've been impressed with what they're doing. So Rally, that symbol rings a bell. We'll look at both. Glad to look at it. Thank you for that. You're doubling down on the super chats, and I believe you're paying me in British pounds, which is more than the US dollar. So that's very generous of you. Thank you. So Crocs. This Crocs is terrible. So we'll comment on Crocs. So Crocs, I believe that's the shoe company, right? And this stock at times, yeah, Crocs. I'll give you my comments on it, and I'll tell you what makes this stock, in my opinion, unreliable, dangerous to our capital. But let's keep going. Let's keep going here. So let me fly through Applovin, and then we're going to get to as many of these questions as possible. Hang with me for just a few minutes. So Applovin today was sold off early, and then, I bought here and it went higher. This is a terrific business. And I say that because it's growing really fast. That's the full year. When you look at the quarterly, similar to, was it Dave that was accelerating its growth? This company is accelerating their growth, and it's a pretty good sized number in the quarter. They're already like a $6 billion revenue company. What makes this an attractive company to me, remember what I said about cash flow. This thing has real good cash flow. Look where they've taken cash flow. $1 billion, which was about 2 years ago. They've 3x'd that number in 2 years. That is fantastic because they have high gross margins, because they're a software company that does ad tech. Look at these profits. Cha-ching. And when you look at where the stock's been, it has been places. And the market knows that this is a valuable stock. So buying this at the right times is key. And it's had a nice pullback recently. So it let me buy some more shares, including today. I bought some more shares. So that's why I'm excited about this stock. It's a really good grower. It's accelerating its growth. It's taking market share away from its competitors, and it's going to continue to grow. Look at that growth rate. 28 analysts are putting in their research, so 19 for 2027. So this number is pretty solid, and they're going to become a $12.45 billion revenue company. So overall, Applovin has gone up quite a bit. And when we look at the valuation of Applovin, I think they're discounted by 35% because of really good high growth rate. It's expanding its free cash flow. It's a known factor now. They do advertising. So when you're watching Netflix and you are on the, I guess the version that plays ads, or Prime, Amazon Prime, they play ads, or YouTube where they play ads, Applovin may be behind that. That's not going to go away. The advertising on different media outlets, Applovin, that's what they handle. So that's a nice fertile market. So overall, I'm buying into Applovin. Applovin could be a good size investment for me. Now, that's what I would like, but the market makes it a little hard because the stock has gone up so fast. It's hard to buy into this darn thing. If you look at the places and the times when this thing was a good buy, right? Here, 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 and then boom, it flies up. So I'm accumulating a little more. It's gone up so fast, really, over the last year and a half. This stock's gone really high. Let me go back to Classic here. So if you look at where it went from, just let's say this point here, which was November 1st, 2024. I guess I could just go the 1 year, 74% higher. So it's hard to buy into stocks that are kind of flying up. You know, you buy in steps, as I do. I've got a small to medium sized position, and it's not because I don't like the company. It's just that it's gone up on me. So this one here, I'm willing to buy more into it, especially if it has some down days, and, you know, own a pretty good sized position. You know, nice 2 to 5% of my portfolio position eventually. And this could be a pretty good sized position in my portfolio. So I think that handles Applovin. Best stock between now and the end of the year. Whew. So I'm going to give you two. That way you can pick your preference. Meta. If you want a big cap that's going to rock and roll, Meta's already beginning to take off. And I've seen this movie before. It sells off and then it goes up. You remember that movie? Or you remember this movie? Or you remember this movie? It just sells off and then it goes up higher. But you see the trend is for it to go higher. Okay. So Meta would be like, I'm buying into Meta. I think it's going to go up by the end of the year. Not financial advice, just what I see and how I'm investing. Giving you my research and sharing with you what I'm doing. Now let's go with small caps. What is that small cap that I think is an awesome little small cap? eToro. eToro is disrespected. And today was a good day, man. Look at that. It sold off. And then we were covering eToro on the investor call this morning. And I had the comments that I'm sharing with you now. eToro. I forgot who asked me. Was it Paul? said, "Hey, what's that small cap that you think is going to do well?" Actually, he asked me this question, which is, as you guys may know, I manage my 25-year-old son's portfolio, and I invest aggressively in that portfolio. What small cap are you adding to that portfolio? I said eToro, and I stick by that. And I said it when the stock was down, and now it's up. I think this thing's going to really go higher. The fundamentals look terrific with this stock. The market's not giving eToro its due. It's this company similar to Robinhood. I give it a high discount rate because it's doing business mostly in Europe, and it's discounted by 50%, has terrific fundamentals. So this would be my small cap pick for the end of the year. All right, let's take a look at let's take a look at Mountain first. I think that's what it's called. So MNTN, Mountain. This is a technology platform, brings performance marketing to connected TV. So this is a little bit like Applovin, FYI. So these guys, you can advertise on social and all kinds of different websites, similar to Applovin. So that's what they're trying to do. And similar to Applovin, this is ad tech. This is a new IPO. Now, I'm careful with IPOs. IPOs tend to sell off, and this one's following suit. Now, they IPO'd, looks like they IPO'd November 22nd, and they've been selling off. All right, so let me take a 5-minute break. I'm going to come right back, guys. I just need to take an emergency call, and I'll be right back with you, okay? All right, sorry about that, guys. Had a little emergency, handled it, and I am back. So we're talking about Mountain, and Mountain operates a lot like Applovin. It's a small cap. They just IPO'd, just less than $1 billion of market cap. Revenues 272. So you're paying less than 4 times revenue. Forward P looks really good at 17. Analysts are pretty high on the stock, saying it's discounted quite attractively. When we look at their revenue growth, the revenue growth is good. Quarterly looks good. Now, Applovin, if you recall, was growing much faster and they're much bigger. So this is good growth, but Applovin's outperforming it. And Applovin's kind of like the big player in the space. And that's where their biggest competition is going to come from Applovin. All right, so revenue is good, but it's not great. Let's take a look at their profitability. And I'm going to go with the trailing 12 months view. All right, so they have free cash flow, excellent. Gross margins 75.55, very good. Very good gross margins, very good cash flow. Okay. These guys are carving out a good piece of the market. They got to keep growing. If they don't grow, the stock's going to tank because everybody's going to look at Applovin and say Applovin's beating everybody. So we have 9 analysts covering this stock, and we have price targets from as low as $18 per share, which is higher than their current stock price, up to $38. Okay. And let's see what kind of forecasting is available. 10 analysts are covering the stock and saying, hey, my forecast shows that they're going to grow 19.4, 17.7. That is not exciting. It's not awesome. Applovin's outperforming that. This is a tiny company not growing very fast. They are going to get profitable, but these guys could kind of sit around with steady growth and being small, and they have to grow faster in order to really be recognized in the market. When we look at, so that's their forecast. I believe their balance sheet's fine. They just IPO, so they should have plenty of cash, all cash, no debt. This will be added to their valuation because they don't have any debt. That's good. So Mountain, compared to Applovin, again, Applovin is performing great. The stock's been selling off. IPOs tend to sell off. The market's pretty much kind of challenging this stock. You got to put up or shut up. You got to start growing in order for the market to get excited about the stock. When I value this company, it's highly discounted. Let's take a look. And this was 9.3, so I think I could update this one here. All right, so you see this high discount because they're a small company. They're IPO. There's some unknowns here. And when we look at their free cash flow for the trailing 12 months, it's a good number. 53,900,000. They're going to be growing sub 20%. So let's go with 18% growth rate there. And we'll change it here as well. All right. So the free cash flow, if they continue to grow, is going to amount to quite a bit. $1.6 billion of value. We're going to add the cash on the balance sheet, which is $179,170,000. They still don't have any debt. So a nice discount based on cash. When we look at their forecast for earnings per share, 91 cents. It's improved since the last time I updated the valuation. Now, 36 is a little too generous. I'm going to go to 25. Even that number is kind of generous. Let's go to 18. And this is a discounted stock. That's not enough. If I sense that these guys are picking up momentum and they actually are going to carve out a part of the market and they're going to dominate that part, that would be a good investment. And what are going to be the momentum builders, right? Because there is a number of companies that do this. Like Applovin's the big one. These guys are $188 billion in market cap. These guys are new, and there's probably like 5 companies. Like Trade Desk is in their category. There's Viant is about their size. They're in their category. So there's probably like 6 to 8 companies that compete against Mountain. So when I look at their website, these guys are trying to compete in the space. They'll help you with your creative. Okay. Okay. So they're doing good things, but so is Applovin, right? So this one here, it's sold off. It's risky. If these guys could start to rally higher, it might get me to be a buyer. Right now, I would watch it. I wouldn't buy it. The other thing that I'd be really attentive to is their next earnings. If their next earnings call is positive and they guide next year and say, hey, we have this new offering and we figured out how to be better and more competitive, I'm on it. So right now it's hold. Okay. The market's telling me I don't like this stock. It's not attractive. And I like the fundamentals, but this is a tiny cap. Okay. Now, if it starts to rally higher, and maybe I missed the first 5-10% rally, that's okay. I'll jump on it and kind of ride the train. But what I wouldn't want is I get in here too early and my capital just sits around or maybe even goes lower, because this is a small cap. It's not like this is a really well-known commodity. So that's where I'm at with Mountain. As you can see, a determining factor for me on investing is my confidence level. I know Applovin, I'm confident, have conviction behind that stock because the discount is not as good as Mountain. Mountain offers a fantastic discount, but when is the right time to buy? So I'm going to watch this stock, see what it's done over the last week when we've had some really good days. Why didn't this rally? Right? Interesting. So Mountain is a hold, but closely watch. That's my analysis on Mountain. Let's take a look at Whirlpool, and then we'll come back to Relly. So Whirlpool, we know what they do. They do appliances. And the appliances that they provide, they sell in the US, and I believe they have a European division now. This has been a stock where capital goes to die. It's really gone down every way you look at it. This is a dividend payer, 4.6%. And market cap of 4.36 billion. Revenue is much higher. This is a consumer discretionary, 44,000 employees, been around for 114 years. And we know what they do. They do appliances. Okay. So let's take a look at their growth. Are people buying appliances? Well, last year they didn't buy any, but it's been 3 quarters since last year. It looks like, man, it has not been a bed of roses to operate in their industry. And I know that during COVID, a lot of people bought refreshed appliances. They redid their kitchens and stuff. That may have pulled demand forward and left very little demand left over. But they were able to grow a tiny bit in the last quarter, which is a glimmer of positive news. That's not a big reason to invest in the stock. Trailing 12 months, that's a pretty good contraction in their top line revenue. So the consumer's not ready to buy. Now, what do low interest rates do for real estate? It really stimulates activity, especially if you have low interest rates. These retailers like Home Depot get into a mode of, hey, we'll give you no interest for 2 years if you buy a Whirlpool washer dryer or a Whirlpool range microwave and whatever refrigerator. And that will stimulate more revenue. So lower interest rates should help Whirlpool. Big picture item, that should help. Their free cash flow has been coming down. In trailing 12 months, it's 62 million. Really low number. So free cash flow, 62 million. One thing I want to take a look at, it's so bad that let's take a look at the historical free cash flow number. So free cash flow historically, see when COVID was around, people were getting all these stimulus checks. They were at home. They're like, well, if I'm going to be stuck at home, I'm going to remodel my kitchen, buy a new refrigerator. And, we were cooking at home because we weren't allowed to go to restaurants. So all that happened here, and they pulled forward all this demand and left very little left over. Before COVID, this was like a $600-700 million free cash flow business. And they'll get back there eventually once things grow. Margins are really low. This is a mature business. They put a lot of money into that product, materials, labor, distribution. So not a lot left. This is not a desirable stock for me. But if you wanted to entertain investing in this stock, it's not a bad time to look at it. I think the low interest rates are going to help them. So that would say that. And you would be paid this dividend. So that's not bad. I don't think it's going to go any lower. If I take 700 million, which was their typical free cash flow rate before COVID, before they had this big spike in demand, and I multiplied that times 10, I get to 7 billion. So that's above their market cap. Let's take a peek at debt, because maybe debt's a problem here. Let's take a look. They do have some debt. They have net debt of 7.3 billion. Well, that makes investing in Whirlpool even harder. Their debt to EBITDA is 6. I cannot touch this stock. I'd be taking home a sick puppy. I'd be staying up all night, bottle feeding it for 3 months. I'd be paying too much attention to something that may not even work. And I'd rather go find the next Google that's going to double in value in 6-7 months. Go find the next Reddit that's going to flourish. Go find the next Astera Labs and buy it at the right time. Wasting my time with Whirlpool is not a good idea. So this one's a complete pass. I would not touch this. The market's telling me exactly what I should be hearing, is that maybe some bottom feeding investors are going to make some money. And if you do, congratulations, more power to you. But it takes me out of my investing lane. My investing lane is finding the next Robinhood, finding the next Taiwan Semiconductor, the next NVIDIA, the next Palantir. I need to go find those stocks. I'm not going to find them by spending my capital and my time with Whirlpool. I'm going to spend a lot of my opportunity, cost, and time on a stock that at best may go up a little bit and not be worth a whole lot in the future. They may even have trouble with all that debt. So Whirlpool is a pass for me. And don't be baited by dividends. It's not my cup of tea to go into a stock to collect, 4.6% dividends. If everything else is in place and I get paid a nice dividend, I'm good with dividends. but everything else has to be right. I don't go after stocks just for dividends. I'll lose money and then be stuck with a dividend payer, which I have to pay taxes on. So that is Whirlpool. Let's take a look at Rally. So Remitly, I knew it. It sounded familiar. Remitly Global engages in the provision of digital financial services in the U.S., Canada, and internationally. It offers cross-border remittances and complementary financial services through mobile application and website. Remitly Global was incorporated in 2010, headquartered in Seattle. So they're a technology payment platform. Okay. So you're sending money from one country to another. Okay. Now this space has been under some pressure because it may be a space that gets disrupted by crypto, but we'll see if that happens. Over the 1 year, this has certainly been selling off like it's not desirable. It's been around. It's a stock that's been traded since 2021, so about 4 years. Really sold off. IPOs, really risky. And it's had its moments, but now it's been on a pretty good drawdown. Oof. Not pretty. Market cap, $2.7 billion. Revenue, 1.5. Less than 2 times revenue. Forward P looks pretty attractive, 14.67. 100% discount according to analysts. Okay, so these guys are in a pretty competitive market. The whole remittances, these guys are competing against old school guys like, is it not Wells Fargo, but what's the other one? I forget their names, but they have some established competitors that do this. And they have some newer players. And they also have maybe some crypto players that are going to come out. Looking at their growth for the last full year was good. Western Union, thank you, sir. Wise, thank you, sir. Very good. And so the last full year looks pretty decent, 33.85. Let's look at the quarterly. The quarterly did have a step down on percentage growth rate. They are going with a bigger number, so that has something to do with it, right? Because you're growing on a number back in 24, they grew at 39%. And the compare is one of the tougher compares. Okay, so that still looks good, right? They're growing well. Okay, got it. Their gross profit looks like the profit's pretty decent. It's going to be about 60%. Let me go to the trailing 12 months here. About 59.4%. It's pretty decent profit. They get left with a little net profit margin. They're still relatively small growing, and their free cash flow margin is pretty decent. Trailing 12 months, free cash flow, $205 million. All right, so the growth looks good. The revenue looks good. The revenue growth looks good. The whole space is under pressure. Sometimes the market thinks, oh, that space is going to be completely turned on its head. They may be right. They may be wrong. The whole market, right? Let's keep looking and see what the fundamentals tell us about this business. And at worst, this might be a really good watch stock. Okay, so revenue growth was good. Margins are decent. Cash flow is decent. 10 analysts cover it. They all think it's worth more by 100%. So big discount based on earnings per share. And their forecast, 9 analysts are putting their research into this summary. And it's expected they're going to grow by 20%, which is very good growth. Not incredible growth, not record-setting growth, good growth. 20%, followed up by 18%. Very good. and their profits are really going to expand. I will use this earnings per share in my valuation. So that looks good. I'm expecting their balance sheet's going to be in good condition. Let's take a look. Yep. So they have net cash of 441, only $35 million of debt. Okay, we're good there. What else do I want to show here? I think we're good there. So do I have Remitly in here? I know I've covered it, but it's a question if I saved Remitly. So there it is. Updated on October 1st. Has anything happened since October 1st, like an earnings call? And the answer is yes. On November 5th, we had an earnings call. So let's update this. Time flies when you're invested in stocks. All right. So Remitly is a smaller business. The space is under some pressure, going with the discount rate of 9%. I'm good with that number. No problem with that number. My growth rate is aligned with what they're supposed to grow with. Let's look at the trailing 12 months free cash flow and see what that number is. That number is $205 million. Okay. I'm going to pump the brakes a little bit on the growth rate. Okay. That is fine. They have excess cash on the balance sheet. They have $476 million of cash. Debt is $35 million. So their cash is going to be worth a lot more than their market. The stock is currently priced at. Way more. Okay. Now let's take a look at what these analysts are forecasting their earnings per share to be for the next full year. When I look at that number, 32 cents, we are good. Growth rate 36. I'm not in love with that number. And then after that, it's supposed to grow quite a bit faster than that. So we'll go with 30% there. So Remitly is a lot like Mountain. These stocks, if these companies continue to generate this cash they're generating for the next 2 years, there's only one way to go, and that's up. So both Rally and Mountain, based on where these stocks are trading, are good watch stocks because the market is not convinced that this stock is going to go higher. It's actually, the market's saying we don't believe in Remitly. So Remitly is going to be treated as if they're guilty until proven innocent. They're going to be treated as they're going to be disrupted until they prove through 2, 3, 4 quarters of really excellent performance and delivering great earnings. Then the market will be like, whoa, this thing's worth a lot more. So as an investor, I would be careful. I would want it to start rallying higher. So here in the 5-day, it's gone up 1%. Maybe that's the beginning of something. It's up 3.6%. So if this establishes an upward trend, maybe throw a few bucks, down on Remitly. But fintech companies like PayPal haven't done all that great. And others, I don't know if they're doing all that great. It is a competitive field. So this one here, I would watch. And if it starts to rally higher, I would be a buyer. their growth rate does make me pause a little bit. It's not like incredible growth rate, like, oh, they're growing at 60%. And the reason I say that is they're small. If you're small, you should be able to grow at a higher percentage rate than they're currently growing. And especially if their growth rate even slows down to like 10%, it's a stock that's just going to bump along a low stock price. It's down to $13 per share, and it's probably not catching much of anybody's interest at this point. So that is Remitly. Some of these small caps, small caps could be so incredible, at the same time treacherous. They can really grab our capital and cost us. They can grab our capital and our capital just sits idle. So be real careful. I think I'm a fundamental investor with a long-term perspective, but I do appreciate what my colleagues that do chart analysis, technical analysis, bring to the table. If they could show me when this begins to rally, there's plenty of upside in Rally, Mountain, Dave, plenty of upside. I just don't want to show up too early, because if I show up early, maybe it costs me an initial 10, 20, 30%, or my capital sits around for a year. I don't want that either. So that is Rally. Thank you for asking. All right, let's keep rocking. We're going to head over to Bill. Let me check on the chat. Thanks again, Mark. You are the super chat sponsor of the evening. Thank you. So we're going to handle Crocs. We've got that one. Tony. This is an interesting question, and I'm going to get to this. And I'm going to get to that question after we cover Crocs. So we got an owner, eToro, and I think it's going to do well. I own eToro, and the fundamentals are really good. I think at some point the market's going to be like, realize it. The reason I'm buying into eToro is because I've done great with Robinhood, and I've done great with Futu, which is similar to eToro in Asia. So I'm 2 for 2 there, trying to make it 3 for 3 with eToro. Any hope for Beyond Meat? I don't know. Let me know if you want to buy a super chat, and we'll take a look at it. And thanks again for the comments that helped me on Western Union Wise. Okay, we are going to move over to Bill, and Bill's a really nice software company that isn't getting a ton of love from the market. Look at year to date, it's down 41.5%, $5 billion market cap company. What does Bill Holdings do? They do software that helps small and mid-sized businesses, and they help with the accounting, accounts payable, receivables. So they're a little bit in competition against Intuit and QuickBooks and that type of space. Now, what's really impressive is this company has been growing. It's a small cap. Market's been selling it off, but the market's been selling off software businesses. I don't know why. I think software businesses are terrific. I'm going to show you the margins on Bill. They're going to look good. This is $5 billion in market cap with a $1.5 billion revenue run rate. Looks good. 3.5 times revenue for a software business. Forward P at 22.2. Growing at 13% in the quarter, 10%. So they're not big, and the growth rate isn't all that amazing. There are some software players like Salesforce that are growing at this rate, but Salesforce is massive, huge software company. So that growth rate of 10% is under impressing the market. That is a problem. They have to grow faster. You're smaller, you should be able to grow faster. And some of these statements, right, are kind of harsh, but that's just reality, right? This is capitalism. And When we look at trailing 12 months, they're growing by 11%. Free cash flow is good. Margins are fantastic at 83.85% for the trailing 12 months. And the free cash flow margin is excellent. So this one here, if these guys can grow faster, I think that's the magic that the stock needs. Okay. Now, when we look at their forecast, we've got 21 analysts covering this stock. And there is differing opinions on a price target. The low price target, $40, high price target, $88. And when we look at the average discount, 23%. They have a fiscal year that ends June 30th. So their June 30th year just ended in 2025. They're already operating in this year. In this year, they're supposed to grow by 12.5, and then their growth is supposed to accelerate. That's good. That's good news. They should be growing faster, and they're going to grow up to $2 billion. So that looks real positive. They're also going to expand their profits. Looks really good. Their PE ratio is going to come down into the teens. Okay. And a lot of analysts cover this stock, 27 and 24 for the next 2 years. When I look at Bill, I do have a discount on the stock, but situation awareness, right? Right now, the market is not paying for software businesses, which is a surprise. Software businesses have been really good businesses. And this is discounted nicely. It's going to grow nicely. But right now, I'm buying into Intuit. That's like the gold standard for small business software. And I'm getting a discount on Intuit. So my choices within software are so good that I don't have room in my portfolio for Bill.com. And it's not showing that it's going to start to rally anytime soon. So it would have to show me that it's in rally mode before I would entertain getting into the stock. And so far, it's not looking good. So that's my analysis on Bill. It really just came off a cliff. And is this a new? No, it's been around for a while. So this really was bid up in 2021, along with a lot of stocks, and it really sold off harshly. And this year, it really sold off February 6th after some earnings. I think they started to really communicate the slower revenue growth percentage. The market did not like that. So Bill Holdings, I think they go by, is it Bill.com? Yeah. Interesting, but they got to up their game. And we got to start seeing this stock rally higher before I get interested in it. There's just too many good choices in software stocks. Rather go to some of those name brands that are doing terrific, but the stocks are really discounted. Salesforce is discounted. Adobe's discounted. Intuit's discounted. Those are real solid names. I'd rather go there. That's where the risk is lower. And the chance of making money is much higher for me. So that's where I stand with Bill. Hopefully you found that interesting. Somebody wanted to look at Crocs. Let's take a look at that. And Crocs, at times, this has just been a really hard rallying stock. It's really gone up. Let me see if I can show you that. Let's look at the history. Look at that. So you had Crocs come out of COVID. Everybody was wearing Crocs at home because, we were all wearing gym shorts and t-shirts for like a year or two. And their stock really flourished. And then it came down harshly, and then it flourished again, down, up. So you see that. Now, is it going to fly up again? Maybe. For sure, a stock like this, if I ever entertain buying it, I'd probably define my sell plan, my exit strategy when I bought the stock. I wouldn't be sticking around too long on this one. Let's take a look at their fundamentals. Okay, so $4.3 billion market cap, revenue $4 billion, net income $182 million. Okay. P ratio is really dropping next year. Analysts think there's a discount. So full year, they grew by 3.5%. We look at the quarterly, we've got some red on the screen. So it looks like in the most recent quarter that just ended September 30th, they contracted by 6%. Before they went up by 3.4, they were flat. So there's some green on the screen, but it's single digit. It's not overly exciting. In fact, it's pretty dull. Now, these are Crocs. They don't cost a lot of money to manufacture. These guys carry a nice margin, 59%. They also sell accessories that you get attached to your Crocs. I think kids have a lot of fun with Crocs. Good for them. Operating margin, 23%. Free cash flow is there. This is a consumer discretionary item. It's a footwear item. And overall, you got to have a sense for, I guess, for fashion and see, do you think are they going to start growing Croc sales? We're heading into winter. I don't know if Crocs are a great winter accessory, but maybe they're a good gift idea for people that are buying gifts for loved ones. 12 analysts covered the stock. They think it's discounted by 21%. Price targets ranging from $75 up to $150. Okay. And the forecast looks bad. They're going to contract for a couple of years. So the market's going to play it safe with this one. That's why their P ratio is dropping. And I don't know that it's going to go anywhere. I don't think any investor wants to jump in and just kind of sit around a stock that is contracting. And a lot of footwear companies like Nike is down on the dumps. Deckers down on the dumps. So this one here is not looking good. Do they have any debt? Let's take a look. They do have some debt. Is it a problem? No, it shouldn't be a problem. It's less than 3. Debt to EBITDA is less than 3. So this one is not my cup of tea. If you understand fashion, if you think Crocs is going to rally because of some type of trend, some type of factor, maybe that's your play. I would just say, if I ever invested in a stock like this, I would have my exit strategy defined when I bought it. It is a stock that will move quickly and it could crash quickly. So that is what you're dealing with when you deal with Crocs. I don't think I've valued Crocs, but let's take a look. Maybe I valued it some time ago. No, but I did value Deckers and Nike, and those stocks are not looking good. Nike is fairly priced, but has no momentum. Deckers has a discount, but I'm not willing to go into it. On Holdings, discounted 9%. Lulu, discounted 29%. But consumer discretionary is not where I make a lot of money. And I like to stay in my lane. I like to stay in my lane and kind of, where could I make money consistently and kind of just keep learning, like positive investment, successful investment. Okay, let's go find another one like that. Go find another one. And I just don't get some of these businesses like Nike. They're not growing. How do you invest in a business that's not growing, that's under a lot of pressure from its competitors? It's just something that I don't have a strong enough grasp, and it's been kind of a loser stock anyway. So that's where I stand with that. All right. So we have covered a lot of ground. Let's take a look here. Smith & Wesson, great to see you. Thanks again for being a member. Mark Stan. Fresh. Let's take a look at Freshworks. So Freshworks, a software development company, provides software as a service products in North America, Europe, Middle East, internationally. the company, and I'm just noting the sticker, the symbol, excuse me, and making a note here. So these guys are a software development company, provides software as a service in North America, Europe, Middle East, Africa, Asia, internationally. The company, okay. So they do customer experience. So selling to customers, providing them support and so forth. Employee experience, HR, help desk, and so forth. Okay. So these guys are probably competing against the likes of ServiceNow, Nice Software, if you're familiar with that company. That's who they're competing against. Take a peek at their website. Yeah, customer service. So, got it. Okay. So, it's a space that has competition. Let's see if they're growing. Let's see what they're all about. These guys IPO'd way back here. They came out with a lot of fanfare. I'm going to say this again. IPOs, be careful because IPOs tend to do this. I've shown a couple examples on this live stream. That's why I'm careful with IPOs. I rarely buy IPOs when they IPO because they do this. Market cap 3.48 billion, revenue 810 million. Forward P 20. Looks pretty good. Analysts think there's a good discount available on Freshworks. When we look at their full year growth, 20.79 for the last full year that ended in December. So they follow a calendar. And they're beginning to show that, hey, as this number gets bigger, the percentage growth is kind of coming down. Now, that is a natural occurrence. But with a small business, you have to tell yourself, well, if Salesforce is growing really well and they're gigantic, like 40 billion, they're consuming more of the market share much faster. And ServiceNow is fairly big too. Those two companies are just gobbling up all the market share. How much is going to be left for Freshworks? They got to grow faster. This growth is not impressive enough. So they're growing at 18%. Free cash flow looks good. $212 million of free cash. Gross margins look awesome. And free cash flow margin looks good. So this business is going to look good. But again, we're in a stock market, emphasizing market being what's the best investment in this industry. So when we look at the valuation of Freshworks, we're going to also look at ServiceNow, Salesforce, Nice Software, and which one has a more compelling opportunity for us? Which one is the lowest risk with the best outcome, best proposition for the investor? So let's take a close look. All right, so the growth is good, but not exciting. Margins are excellent. Free cash flow is good. 16 analysts cover this stock, and they have price targets from $12 up to $27. And I already forgot, has this stock been rallying or going down? Going down. Yeah. All right, so analysts think there's a real healthy discount available on this stock. We do have a good number of analysts putting their research into the overall summary collection average of this company. They're saying next year it's going to grow by 13.79, 16. So that looks good, getting to be north of $1 billion. Profitability looks good. Okay. All right. So Freshworks. Let me see if I have a valuation on these guys. And there it is. It's discounted. Not a surprise. Discounted nicely. Again, small company, not known, not really. Will it rally at some point? Maybe, especially if it gets acquired. But I'm going to go up here. ServiceNow, not priced well. Oddity, priced well, small cap. I was hoping to see. So Wix is discounted nicely. This company does software for websites. Intuit, discounted by 20%. My confidence in Intuit's really high, so that's why I'm buying into it. Salesforce, discounted by 48%. I'm buying into Salesforce because this is a very well-known company with huge revenues, huge free cash flow. Its valuation is massive. This has a lower risk profile than Freshworks, and it's consuming a lot of the market share. So is ServiceNow. What's going to be left for Freshworks? Not a whole lot. So I'd rather, if this particular industry is really sold off, I'd rather buy the highest quality stock that's going to have the best longevity, that has terrific fundamentals. Sign me up. So I'm a Salesforce stockholder. And that's what I'd rather do as opposed to Freshworks. And Freshworks has been on a sell-off. So has Salesforce. When will these stocks rally? I don't know. The market is hard to predict what the heck it's going to do with software companies. Let's take a look at the heat map. This box here representing software applications should not be this small. Now, the market's been in love with semiconductor. And that's putting it lightly. It's also been in love with these big hyperscalers, Microsoft, Google, Amazon. It's been buying these up, making this space less compelling or less relevant and discounted. This space will come back someday. I'm watching it. I'm investing. And once it starts to rally, I'm going big in this space. But for now, the market hasn't been doing much with this space. So that is Freshworks. It is a watch. There's other alternatives I'd rather buy than Freshworks because we're in a market. I'd rather go to the market and buy what is the best investment for my portfolio. And that's what I would do. Okay. Now there was a question asked, I think a comment that Tony made around he's observing an AI bubble. And I think we're in a bubble. How big the bubble is, that's where we can argue. But this space has really been bid up. And so have the hyperscalers as well as some others. Now, one thing we saw today that was really interesting is NVIDIA sold off. And at one point, it was down by like close to 7%, which was like, whoa. AMD was down 8%, 9%. Micron was down. So this whole space was under threat with the story that Google is having success with its chipset that can be an alternative to NVIDIA with regards to the inferencing phase of AI. So that put a lot of pressure on NVIDIA, and Google's in partnership with Broadcom. So Broadcom caught a bid and it went higher. Back to the AI bubble question. This shows that investors are quick to sell on concerns that maybe I'm riding the wrong horse. Maybe I should be on this horse and this horse. So that's quick, not based on fundamental action, showing that, yeah, we're in some kind of a bubble. Is it a big, dangerous bubble? No, I don't think it is. I think it could end with NVIDIA selling off, Broadcom selling off, I don't know, 30, 40, 50%. But I don't think it's going to take the whole market down, especially since investors can rotate into healthcare, they can rotate into software applications, they can rotate to other places. Now, if these boxes keep getting bigger, let's say NVIDIA got to 6 trillion in market cap and Broadcom got to 5 trillion in market cap, we'd be in full bubble mode. at that point. Then it would get pretty dangerous where, hey, the market's going to be terrible for 5 years. And then we'd all be investing in bonds and stuff. We're trying to weather a really, really bad market for a while. Because that's what happened with the .com era. Let's take a look at that just from let's go to the history books. All right. We're going to get there. No, we didn't go far back enough. Why isn't this? Oh, because that's the future. Sorry. User error. Max. Okay. So here is when. Yeah, this should show it to us. So here's where 1999, 2000, the market was way up here. And the point I want to make is once it hit a high, it took a long time. Look at that. To get back to even. It took 12, 13 years to get back to even. That's how bad this bubble was. And the stars of that bubble show were Cisco. This was the star of the show. It spiked. It went like crazy. It was the most expensive stock in the market. And it went up 55,000%. And then it crash landed. And investors have never gotten back to that peak after 25 years. The other star of this show is Intel. This star of the show also took off during the .com bubble, went up sky high, and Intel has never gotten back to its valuation again because the stock price just became so high. Even though their stock prices were crashing and burning as if these businesses were going bankrupt, they weren't. Both Intel and Cisco continue to grow their revenues, showing what a business ought to be doing, growing by very good percentages, expanding margins and cash flow. Market didn't care. They're like once bitten, twice shy. And the price of the stock got so overheated that you had to stay out of this stock for 10, 12 years before it started to perform. Even the great Microsoft did not make it through unscathed. It also went up, and it took a long time because this was a real great business. It took a long time for it to get back to even. It took roughly 15 years. So that's what I don't want. I don't want a bubble like that. We have a correction in the market, good crash. We're like in 2022, the S&P was down 25%. That was a rough year. Definitely a rough year. But we made it through. It provided some really good opportunities. I've made a lot of money on the stocks that I bought back then. I'm okay with that. I just don't want this big giant 10, 15 year problem. And if the market keeps bidding up to some of these stocks, that's what we're going to be dealing with. The positive that we've seen for the last month is the market did give up some of its gains. So we did take some medicine. I think it was 5% on the S&P. All right, we took some medicine. Some of these stocks that were flying high, Nvidia and others, they came down. They came down a couple pegs. Good, that's healthy. Let's not have overly high stock prices that we have no chance of getting to that valuation in the next 5 years, because then we're just playing with monopoly money. I like playing Monopoly once in a while, but I never pretend that that's real money. And when I invest in stocks, that's real capital. That's hard-earned capital that I want to grow. I don't want it to go away. So we had an awesome session, everybody. I hope you enjoyed the stream. Mark, thank you, sir. I bid you a very good night. I bid you good luck on your trades tomorrow. And I thank you for the $20 in super chats. Members, Benton, good to see you. Thank you for joining. Smith and Wesson, great to see you. Thanks for coming. Everybody that joined, thank you for coming. Tony, great to see you. Smith and Wesson. Thanks everybody for joining the stream. It was an awesome stream. And I know I'm missing some of you guys. DJ, thanks, man. Thanks for tuning in and spending part of your afternoon, evening, or in other parts of the world, late evening, middle of the night. Thanks for joining. Very good stream. I'm going to stream tomorrow morning. I don't know that you guys want another session like this, but the afternoon sessions, I'd like to slow things down, make it so that we're going through the valuation steps, looking at stocks, trying to see all the different points we ought to be looking when we look at a company that we think we're going to put our hard-earned money into. And in the morning, when I do solo, when I'm with Daryl, it's going to be similar. In the mornings, I'm going to focus on the open. What's going on? How should we be getting our head into what trades ought to be happening that day? What's the market doing? Once it closes, it's all about, okay, the market closed. There is some reflection available there, but maybe we can really focus on, hey, let's really analyze some of these stocks and take our time. The market isn't open. It's not like, oh man, I got to make a quick decision and buy like NVIDIA when it was down almost 7%. So hopefully you like this style, and that way, you could tune in the evenings and we can really take our times, be methodical when we look at these stocks. I really enjoy looking at stocks because when you read through financials, you really get to know businesses, you make good investing decisions. And boy, it is so fun to watch winners win in my portfolio. It is a real fun activity. What's also awesome is collaborating with you all. Thank you so much for tuning in. And members, I really thank you tremendously. Thanksgiving is 2 days away, but I think the conversations we have on the investor calls, the streams we have, I've become a better investor over the last year. I hope you've picked up some knowledge, some ideas to become a better investor. And I'm very thankful for that. Just putting it out there. And I'd like to get better. I like to get better at streaming and providing good content for you guys to absorb, reflect, and hopefully help you have one more point of view as you look at the stock market and investments. So, Bo, you're awesome, man. Thank you so much. I'm glad you feel that way. That really is huge energy, or I should say a lot of fuel for my passion to do this, because that's exactly what I want to do it. And I really appreciate that. Thank you. So that's it, everybody. Have a terrific night. I really appreciate you joining, and good luck with your investments. And I hope to see you soon. Take care.